Doing a bit of research on how the institutions, the banks, the private funds, the hedge funds, the prop traders, how they trade, and essentially, if you want to copy the way they trade, that's fine. So in this four-part series, I'm gonna share my research with actual institutional traders talking about how institutions trade, how they personally trade. And this isn't just another retailer telling you how the institutions trade when I've never traded at institutional level, which is what a lot of retailers do. They'll tell you this is how the institutions trade, yet they've never traded at institutional level, nor do they even know anyone who trades at that level. So this is based on institutional traders who sharing what with retailers, what we can learn from them. Not to say that they know everything or that they have stellar track records. It's just that for struggling retailers like us, we can learn a lot from them. So this is the first institutional trader. His name is Trevor Neal, and he's also an educator to institutional traders. So here's his take on the difference between retail and institutional.
The it's quite interesting that I think that in many occasions the wholesale market, the institutional market, is often trading against the retail market at the very same moment where what one is buying, the other one is selling. For example, if you think about a support line, for example, you might think that, well, this support line may hold. Also, the institution may think this support line may hold. The support may be the day's low, the month's low, the pivot low, something like that. They're seeing the same thing as you. Now, how might you react to this? Well, you want some confidence. So you might see that the approach to the support line is weakening, so the candles are getting smaller and the bodies are getting smaller and the volume is lightening. And then you have a nice white candle, which gives you the feeling that we've reversed up and the close is now well off the opening, and so it's turning. And you might, as a retail trader, say, if it follows through on the next candle, I'm going to buy and enter the market. I've got a very obvious place for a stop, which is below the low of the recent candles, and that's where I'll enter there. Now, what you don't realise is that the institutions, because of their size, they could never do that. They couldn't wait for that late stage. If they start buying at that point, they'll push the market away from them, and they won't have got enough size on board, enough position on board, and the market will have already run away. So they've already had to have participated. So as the market comes and starts to look as though it's going to hold and not fail, they'll be the buyer. Actually, they caused the white candle that you're now seeing as the trigger, and they've already started to buy. It's risky because they're buying early. They haven't got the confidence that you've got, but they have to participate earlier than you. And so they are buying, and they will possibly be selling, having already bought at the very moment that you are buying. And so they are the wholesale participants, and you are the retailers.
So I'm surprised, firstly, that institutions also believe in support and resistance, and they make use of support and resistance. But he mentions that actually institutions carry more risk than us retail traders, although we think that because they are experts that they carry less risk. He was saying that in fact they not only have to predict the move before it happens, they have to as well create the move that we see. And I think this is why people say trade with the big money, because once they have created the move, that's when you're supposed to jump in. So you're not supposed to be predicting what's going to happen or know what they're going to do. You just have to follow their lead. When you see a conversion and you see a changing direction, that's when you should know that big money is getting in, and that you should also change directions with them. I think that's why people were saying you should follow the big money.
Use your advantages, and certainly don't be drawn into and seduced into areas where you are at a clear disadvantage. And these areas are you haven't got size, you cannot trade faster than institutions, and so go where you've got an advantage over them, which is more in the intermediate term, doing technical analysis, become systematic. You can do all these things as well as they can do it. They may have sophisticated algorithms for short-term trading and high-frequency trading and machine learning algorithms, but they're all gravitating towards this shorter time frame. Just leave that alone, let them have that. But go to an area where, if there's a trend in the market which is driven by the demand of the security, the fundamentals of security, that's what's moving the price. They can't change that. It will be the same for you as it is for them, and you'll be able to see it as well as they can see it. Maybe you could even see it better because you're working under less pressure than they are, and you're got more time and you're doing it more slowly than they are. So go where you've got your own strengths and avoid the areas where you're at a clear disadvantage. It is for me. I'm not saying swing trading is a sweet spot for me. I'm not saying it is for everybody. It's just when I ended managing a big fund and went into a smaller fund, I then didn't have anybody telling me what to do. So I had the opportunity to go to do what I thought was best and what would be most profitable rather than suited the investors the best. And so I feel that I have no skill or ability to forecast 6 months or a year ahead. It's a guess like it is for anybody, but most people don't admit it, but the reality is who knows where it's going to be that far ahead. The short term is very difficult to trade for different reasons. It's difficult, but also you've got the disadvantages of all this power that these institutions have got. But I would head for this area, which I would think is with a horizon of about a month for your holding period, something like that. That's typically swing trading, trading the ups and downs in a long-term trend. And there you can do that just as well as any institutional trader. You're not at any disadvantage. The size is not a problem, and you've got the same tools as they've got, the same data as they have got. So go where you've got the same level playing field as you're playing in the same level playing field as they are, and I think in some cases you'll be able to do it better than they can.
So this next trader is not an institutional trader. He's a retail trader, and he's been doing this for over a decade. And I've been watching him for the past 5 years. He's profitable. He's a really good guy, a really nice guy, and he's been on interviews. He's been on newspapers. His name is Siam Kid, and really smart guy. And here's his take on manipulation and essentially how the big institutions go about manipulation and trading, and how they screw the retail traders off. And he says that FX is really hard to manipulate, but things like cryptos and public stocks are much easier. And I agree with his take here.
So what probably happen is that the CEO will have a chat with the head trader and go, hey, we need to get as much of this stock as possible, go and make it happen. And if you get the bank in a position below a certain price, you get extra bonuses for your year-end bonus. And you have to understand that the floor traders and the head trader live for the year-end bonus. So they're not so worried about what ROI they make. They just need to make sure that they get it, they have to hit their certain missions. Because, there's some traders out there in Wall Street making $50 million bonuses by Christmas. So they don't really, they trade in a way different way to how the retail market does. So let's just say, a certain bastard bank is on the sidelines and wants to buy as much ABC as possible because they see it going all the way up to £6, £6, and right now it's hovering at around £1, right? So what the CEO may say to the head trader is that, right, I want to buy, I don't know, £1 billion worth of ABC company, but I do not want to pay any more than like an average of more than £1.50. So that's the max. And if you can get it, lower than £1.50, then you get more of a bonus, right? So that will be the directive. Now the head trader will go, right, okay, let's make this happen. He is nearly always going to be a he, unfortunately. We'll get the team of traders go, right, this is our mission over the next couple of months or year. We need to get as much ABC stock as possible below this price, and you guys get all your bonuses if we hit a certain price, right? So the incentives trickle down. So here's what they do. Like, a lot of people would think, right, it's hovering around at £1 now. Why don't they just go and buy £1 billion worth at £1? And Job's your uncle. Job's your uncle? Bob's your auntie. One of those things. Bob's your uncle. But the thing is, the second that they just dip their pinky of that, they put it into this stock, it's just going to spike the stock up, right? And they will not get their whole $1 billion worth of stock at that level. So they can't just go long, because it would just, one, they wouldn't get filled. And if they did get filled, it would be filled all the way up here. So that's not what they do. Remember, the overall essence of trading is that if I want to buy $1 billion worth of something, there needs to be $1 billion worth of people selling that exact same stock at the same time, at the same price. So if you want to buy, you need to find a seller. If you want to sell, you need to find a buyer. So here's typically what happens. So what they may do is it's a bit counterintuitive. They may put a little few buy orders in. So let's just keep this green and red. So green is buy, red is sell. They may buy down here, okay? Not much, but enough to move the market up. So the market has a bit of an uptick, and let's say they keep on buying throughout, okay? And the market's starting to go up. And what they're trying to do is create a bit of a trend, because they know every idiot on the planet has been taught or self-taught, the trend is your friend. And again, most people aren't aware that the trend is your friend until the bend at the end. Anyway, and it doesn't take much to start a positive trend on the 5-minute chart. You can do that in a day. You can do it in a couple of days. So what they'll do, they'll start getting this going up, right? And they may even zoom it all the way above $2, right? And what they want is to create a bit of a frenzy. So they could be doing some underhand tactics. So what they could do is pay a whole bunch of journalists and TV programs and celebrities to go, oh my God, ABC is shooting through the roof. So that's why you should be cautious of talking heads on TV. You don't know who's paying them or sponsoring or donating to their charity of choice. Anyway, this then gets media attention from going from $1 to $2 and £1 to £2 pretty much very quickly. And here's what happens. When they see, they're monitoring the order book, when they see there's a lot of buy orders coming in, guess what they're doing? There are two things. They're closing their buy orders, their longs. So they're taking profit, let's say at $2 or just before. But at the same time, so by closing their long positions, that's actually adding negative pressure, and then they're most likely putting in some absolutely massive sell orders. So what they may do, they may put in a massive buy order here just to spike it up like that. But as it's spiking up, they'll probably be closing there for a profit. So that big buy order is actually going to make way more profit than the previous trades. It'll create the spike, then they'll close the trades and then start selling, sell. And then you'll probably see a massive drop in price, okay? Something like this. And then the price will dump. And here's what's happening. During this sort of period, everyone is like, oh, God damn, I'm in pain, because most people started buying in the frenzy up here. And it's during this, people then go, oh my God, it's crashing, let's sell. So what they're doing is buying into the sell. So as people are dumping their stock, they're buying. And as the market is bottoming out, guess what they're doing? They're slowly accumulating their £1 billion position all the way up. So then let's say they got the chunk of their order here. It's gone to sleep again. So yeah, and they're doing that. And then guess what may happen? So when we get to the level of the previous all-time high, or the previous local high, guess what a lot of people are doing? People are underwater and in pain for all of this bit here. So this is called anchoring, negative price anchoring, because what they're doing in their heads going, right, the moment ABC gets back to £3, I'm selling, I'm getting out, because this has been such a bad investment. So what this then does, you may sometimes see when we hit previous highs, it have a bit of a sell-off. And that's because people are selling. But hey, it doesn't matter, because what they'll be doing is buying, constantly buying, or they'll be making sure that the bulk of the buys below 150. And then they'll probably put a big mother load of orders in somewhere around here. And then the stock does this. Hits their take profits, and then they start doing the same old thing, but they start offloading their position around this area there. Everyone gets their big fat bonuses for Christmas, and yeah, that's about it really. So what we're going to do now on this side is get our big magnifying glass and look at a few things. So if I get a magnifying glass and look at this here, this is a magnifying glass, and I want to show you a slightly more zoomed in version, because sometimes in order to create an upwards trend on the lower time frames, because a lot of people are looking at the lower time frames, what they tend to do it in 3 stages over a week. I mean, it's not always, but I've seen this a lot. And it depends what we're looking at, but what you can see is 3 big surges: Monday, Wednesday, Friday, typically. So let's say Monday, Wednesday. It's not always. I'm just saying Monday, Wednesday, Friday. And a lot of it is counterintuitive, but when you understand this, it really does make sense. So what may happen is they'll put, you know, some buy orders in or whatever, and they'll start a bit of a rally, okay? Market goes up, and eventually the market will get to a level where there's some temporary equilibrium, so the bulls are matching the bears, vice versa. And this is why sometimes when you hit that, you get a bit of consolidation. The price doesn't really do anything, it ranges for a bit, and then it naturally creates what's called a bullish rectangle. And I mean, I'm going to talk about this later, but I may as well give you a little insight now. A bullish rectangle is a continuation pattern. So what this means is that this should continue going up. But what happens is every man in, so again, being quite granular here, typically what most people have been taught with a bullish rectangle is to, broken pen, is to put their buy orders here, put their stop losses here, and hoping to catch the breakout. That's what everyone does, and that's what you should not do, and the banks are aware of that, or the big boys are aware of that. So what do? They can do a few things. They can have a bit of a fake out, so it goes up. So these days rectangles become a bit messy because they drive the market up, so everyone gets in, so everyone's like, oh, it's breaking out. They then smash the market down here, because guess what? They're trying to take out their stop losses. And then this is where they're buying, okay? So again, so they're putting in a little buy order here to drive it up. They're then putting in a big sell order to smash it all the way down here. And then they're buying down here to really then zoom it up. And then guess what? The market does this. Yeah. So what they've done is they've made a bit of profit up here as they're faking it out. They're taking profit. They've massive sell order in there. They're taking profits down here, so they made profit down there. And then they're making profit as it goes up anyway. So then it creates another, guess what? Bullish rectangle. You don't, a lot of the time you see bullish rectangles strung on each other. And you see the same thing happens. Spike, spike, whee! Etc. And they'll do the same thing all over again. And this is what goes on here, and that just created this. Now, obviously I doodle all over that, but do you recognize this pattern? This is pretty much what Bitcoin's gone through over the last couple of years. Why do you think it shot up to $19,000 then down to $3,000? Well, there's a lot of big people out there, billionaires, that have gone, oh, okay, maybe Bitcoin is something to be interested in. Right, I don't want to get in at 20,000, I want to get in at 3,000. Right, let's do this whole shenanigan routine, dump the stock or dump the cryptos, and then we'll get our fill in, and then we'll just let it go boom. So yeah, that's how the banks trade. So here's what I always say, as a trader, you need to be, I can't draw fish, but when you see a great white shark, something like this, there's always a, it doesn't look very scary, maybe it's more of a pointy nose. Nearly always with a great white shark, you'll see tiny little fish swimming below its belly or above it. That's who you need to be, unfortunately. The banks, the big boys, they are the sharks, they're the great whites, but you are the tiny little fish swimming under its belly, just eating the remains of it, of whatever it's eaten. So don't fight the big boys. Flow with them, trade with them. So identify what they're doing here, and if you can see something like this and go, oh, okay, this is where smart money is going to be buying, that's where you need to buy. Makes sense? Well, to me it does anyway.